Let's talk about a 1031 exchange. It's a tax-deferred exchange of real estate that allows investors to sell one property and use proceeds to buy another property without paying capital gains tax on the sale. To qualify for a 1031 exchange, the properties involved in the exchange must be like kind, which means they must be used for a similar purpose and be of the same nature or character. For example, an investor could sell a rental property and use the proceeds to buy another rental property, or sell a commercial property and use the proceeds to buy another commercial property. There are a few key requirements that must be met in order to qualify for a 1031 exchange. The exchange must involve the sale of one property and the acquisition of another property. The properties involved in the exchange must be held for use in a trade or business for investment. The properties involved in the exchange must be like kind, as we talked about. The exchange must be completed within a certain time limit, which is typically about 180 days from the date of the sale of the property. The investor must designate the replacement property in writing within 45 days of the sale of the first property. Overall, a 1031 exchange can be a useful tool for real estate investors who want to defer capital gains tax on the sale of a property. However, it's important to carefully follow the rules and requirements for a 1031 exchange in order to qualify for the tax-deferred treatment.